Okay, hope you can. Can you see my screen? Confirm if you can see my screen.
Yes,
Okay.
yes.
Yes, I can see your screen.
All right. So what we are going to discuss today is candlestick and their behavior. That's what we have in our schedule. Well, when we talk about candlestick is just a simple representation of price. It's just a simple way of that price is being represented. Of course, we know that candlestick is not just the only way that price can be represented. There are different ways that we can represent price. Like if you're on TradingView, if you're using TradingView, we're all entitled to a TradingView account, because it doesn't take much to actually get a TradingView account. All you just need is an email and a password. Then you have this free version of the TradingView, where you even in this free version you have all the necessary tools that can actually make you a successful trader. Then as you progress, when you actually start making money from the market, then you can think of getting the paid version with more fixtures. Okay, so like I was saying, that candlestick, when we talk about candlestick, it's not that that is the only way that price can be represented. There are different ways that price can be represented. Like we can use these hollow candles to represent price. We can use columns. This is still the same, the price. We can use line. This is still the same chart that we're looking at. We can also use anyone. All what we have in this drop down are just different ways of representing price. This one is area. This one is there are most persons. Okay, so this one is area. Yeah, most persons that like the wrinkle. But if you're using the free version, this wrinkle, you can only have it in the daily and no other time frame, unless you have the paid version. That's when you can actually make use of the wrinkle and then have all the time frames displayed. Then but the most used price representation is the candlestick. And the reason is because the reason why most traders prefer using candlestick is because candlestick gives you the information that you need to actually succeed as a trader. And that information is that in each candlestick, it doesn't matter the time frame that you are looking at, you have the low, you have the high, tells you where price opened and where price closed. So this is what you need. That is, every candlestick gives you this vital information, which is what we'll call the open, close, high, and low. Or we can represent this as open, open, close, high, and low. So the open, that is depending on, of course, the candlesticks are represented in time frames. We have from the smallest time frame, like if you have the paid version of a trading view, you can see these candles can even be displayed as low as 1 second, meaning that every 1 second another new candle will form every 1 second. So if you have the paid versions, you have these candlesticks in seconds. But if you're using the free version, then from 1 minute down to the monthly, we even have 3 months, we have 6 months, and even a yearly candle. So each of them gives you, when you're looking at it, it gives you just that, the basic information you need. That is, depending on that time frame, depending on the time it took that candle to form, what price did it open? What price did it close? What was the highest price it got to? And what was the lowest price? So like the candles we are looking at now is a daily candle. So each of them takes 1 full day to form. At the end of a 24-hour period, another new candle will start forming. So each of them, like if we're looking at this one, for example, we saw that the previous candle closed at this price. So at the beginning of the next market day, the market will open at the exact price that the price closed the previous day, or the previous candle, as the case may be. But then this was the lowest point it got to. This was the lowest point it got to. This was the highest point it got to, but this was where it closed. So with this now, with the way, so if price, now look, if price opened here and closed at the top here and made a high, so it just simply tells you that the market was bullish on that particular day that we are looking at. So even if you're as simple as the 1 minute time frame, the same thing still plays out. We still see the same thing playing out. At the end of every 1 minute, a new candle will start forming. At the end of every 1 minute. But the same thing is, as we're looking at it based on that time frame, we're interested in what was the low, what was the open, what was the lowest point it got to, and where will it close. So that's what we are interested in, based on that, based on whatever time frame that we are looking at the market. So I don't know if that's clear. Are we following?
Yes, sir, very clear, sir.
Okay. So that's why candlesticks are the best or the most preferred way of representing price, because it tells us based on the time frame, like the one we are looking at now is the 1 hour time frame. Every 1 hour a new one forms. So if we're looking at this one, so at what point did it open? Where did it close? What was the highest point it got to, and what was the low of that time frame that you are looking at. So every candlestick gives you that information. All right. So do we have any question on that? Any question? Any question? It's an interactive class. All right, so if we're clear on that, then one other thing I want to point out is that when we are looking at the candles, if we see a fully formed candle like this, when we see a fully formed candle, a candle with full body, it's just an indication that there is momentum, there is strength. It represents strength. It's usually called an engulfing. Like if we're looking like this candle now, imagine the market was doing what it was doing here. So the market was just moving up, down, up, down. There was no much activity here. But then, when as someone who reads the market, and then suddenly, when this candle dropped here, then you now saw a candle that went impulsively in one direction, and then took out the high of the previous candle. So this one here now is an engulfing candle. It's called an engulfing candle. The same thing happened here. This too was an engulfing candle. This one too was an engulfing candle. Now, why is it called an engulfing candle? It's called an engulfing candle because it engulfed the previous candle. When we say it engulfed, it actually it kind of swallowed the previous candle. The same thing happened here. This was the previous candle. Now, when this one came out, it swallowed such that you can put this previous candle inside of this, and there will still be a leftover. So this, when an engulfing candle usually shows, is a sign of momentum. It's a sign that usually when an engulfing candle appears, you just know that price usually goes up to a very high percentage. Price usually goes in the direction of the engulfing candle. So when the market is somehow indecisive, not really making any move, and then you see an engulfing candle appear, so you just know that the market is pointing to that direction, that is where it is going, that is where price is very most likely to go. So you want to always look out for engulfing candles like this, especially at a point when you are about to enter the market, and there is somehow indecision, like here. You noticed that somehow price was indecisive. Then this one appeared as an engulfing candle. It engulfed the previous candle. This was the previous candle. It engulfed it. So an engulfing candle is pointing that is where price is most likely heading to. I don't know if that is noted. So an engulfing candle signifies momentum in the market. So if there is any candlestick you want to fall in love with, You want to fall in love with that engulfing candle. That engulfs, especially when you are able to point it out or see it on a higher time frame. When you are able to see it on a higher time frame, it's very helpful. You want to look for it at key levels in the market. Okay, so you want to look for it at key levels. Then another candlestick that you also want to look at for is the doji. Now, when the market is moving in a particular direction, and then you begin to see candles like this, like let's say, as just like we had a market impulsively going up, 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 up. Then at some point, there is a point the market will get to, and then you begin to see candles like this, candles without body. So it's just like the cows, the cows in Pharaoh's dream that we have skinny. So when you begin to see those skinny candles without body, those forming dojis, forming wicks, they come, and at the end of the day, they are, so these one dojis are, they are simply indication of lack of momentum, lack of strength, because there are two people or two groups that drives the market. We have the buyers, we have the sellers. So at each stage in the market or each phase in the market, one of these group will be in charge. We will have more sellers than buyers in the market. So when there are more buyers in the market than there are sellers, the market will be moving. That's when you begin to see, begin to see push like this. You see the market pushing in one particular direction. Like in this case, you see that there are more of green candles, more of green. The green here, according to the way I set my trading view, the green represents when the market is going up. So when you see a move like this, here you just see green candles all going up, 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 up. So you just signal that there is bullish momentum. The candlesticks are telling you that those who are the buyers are in charge of the market. Okay. So like in the daily here, we're seeing 1, 2, 3, 4, 5, 6, an entire week. In addition to today, we're just having bullish momentum. Now, at some point, these people who are buying the market will be a kind of must have gotten enough, and they will want to start pulling out or start taking some profit. So at that point, when they will start taking profit, instead of seeing full body candles like this, we begin to see what we have today now. If you see here now, you see that the market is forming a doji, a candle without body. So when you see that, especially after a move in one particular direction, when you see that, especially when you've identified a move in this particular direction, you just know that is a signal or a sign that these persons who were seriously buying the market, because they cannot buy the market forever. At some point, they will want to take out something. They want to take profit. Some of them will be going out. So as they are going out, selling out their position. So that strength, that initial strength they were using to push the market in that direction, will start weakening. So that is when you will now start seeing candles with no body or doji. So for me, these are the two very important candles that you want to pick out. The engulfing, the one that swallows the previous candle, and then the doji. Why the engulfing signifies strength, either bullish or bearish strength. The doji is an indication that there is lack of momentum in the market. So when you want to ride, when you want to join a trend, you look out for engulfing. Look out for engulfing candles. And then at a point when you want to go the opposite direction of the market, so you want to make sure that momentum is no longer there. So that's where you begin to look out for dojis. A typical example is what we have here. An example is what we have here. We see that in 2 days, we had a market going down. But on the third day, we had what? A doji. So as someone who understands candlestick behavior, when you have these two candles that were selling, and then on the third day, you now see a doji. So that is an indication that the market wants to change its direction. So when you read some trading books, like if you've read a candlestick Bible, you see that they now combine this 1, 2, 3, and then give it a name. Okay. So these are behaviors of candlestick that you want to note. Okay, does anybody have any question, or I should write down? You have a question?
Write down.
Okay. The meeting is going to time out in about 2 minutes. So when it times out, just rejoin. Is that clear? Just rejoin. Did you get me?
Yes.
Yes, sir.
Okay.
Yes, sir.
All right. Okay, so these are very important behaviors of candlesticks that we want to be able to pick out. So when we pick them out like this, then they become easier for us to actually start reading the market. Okay, so now when we are, apart from looking at the candles individually, just like we've been able to analyze them, where we are looking at, okay, individually, what is the open, what is the close, what is the high, and what is the low. And then begin to look, okay, is this one an engulfing candle? Is it a doji? So we can also be looking at them in this case as a group of not just individual candles, but we can put a group and still be able to know the message that they are passing to us. So now this is, if we are looking at it that way, we need to understand the way the market moves. We need to understand the way the market moves, because the market moves in patterns. The market moves in patterns, or the candlesticks, they actually move in patterns. Now, this is the market moves in pulse. We have impulse, then we have a pullback or a correction, and then we have a continuation.